December 2024. While retail investors debate whether to hold cash, buy gold, or get into Bitcoin, the ultra-wealthy are doing something completely different. They're not choosing between the three obvious options. They're making a fourth move that most people don't even know exists. And it's not secret. It's not insider trading. It's not illegal. It's just a completely different game being played on a different board. Let me show you what I mean. When Silicon Valley Bank collapsed in March 2023, retail depositors panicked, tried to withdraw money, moved funds to safer banks, bought gold. Some rushed into crypto, all reactive, all fear-based, all playing defense. Meanwhile, a handful of private equity firms and family offices did the opposite. They raised billions in capital specifically to buy distressed assets from the wreckage, not after the crisis, during it. While others panicked, they prepared to acquire. Apollo Global Management raised a $40 billion credit fund in 2023, specifically targeting distressed debt and struggling companies. Blackstone increased their real estate opportunity funds. Ares, Oaktree, KKR all raised massive capital for crisis deployment. They weren't protecting wealth. They were positioning to multiply it. This is the difference between wealth preservation and wealth creation, between defense and offense, between reacting to crisis and profiting from it. And here's what nobody tells you. The strategies the ultra-wealthy use aren't actually complicated. They're just using different information, different time frames, and different risk tolerance than normal people. You can't replicate their scale. A family office managing $500 million can do things you can't with $50,000. But you can understand the framework. You can use the same principles at your scale. You can stop playing the panic game and start playing the preparation game. Let me break down what smart money is actually doing right now while everyone else argues about cash versus gold versus crypto. Move 1. They're buying cash-flowing assets at distressed prices. When markets crash, when banks fail, when crisis hits, assets get sold at fire sale prices. Not because the assets are worthless, because the sellers are desperate. Commercial real estate right now. Office buildings in major cities are trading at 50 to 60 cents on the dollar compared to 2019 valuations. Why? Because companies went remote. Occupancy crashed. Buildings can't service their debt. Lenders are forcing sales. Retail investors see this and think, office buildings are dead, stay away. Smart money sees Class A office buildings in prime locations at 60% discount. Occupancy will recover eventually. Buy now, hold 5 to 10 years. Massive returns. They're not buying to flip. They're buying to hold through the cycle. They have the capital to wait. They have the time frame to be patient. Same thing in multifamily. Some apartment building owners over-leveraged at low interest rates, now refinancing at 7%. Can't afford it. Forced to sell. Buildings aren't bad. Management was over-leveraged. Smart money buys the buildings at a discount, refinances when rates drop, holds for long-term cash flow. This is crisis investing, not stock picking or market timing, buying real assets at distressed prices with long time horizons. You can't buy a $50 million office building, but you can buy shares in private REITs that do this. You can invest in syndications that pool capital for these acquisitions. You can apply the same framework at smaller scale, buying distressed single-family homes, small commercial properties, mobile home parks. The principle is the same. When everyone's selling in panic, be the buyer with capital ready to deploy. Move 2. They're creating private credit funds. When banks tighten lending, like they're doing now after SVB and First Republic, companies can't get traditional loans, but they still need capital. So they turn to private credit. Private credit is lending outside the banking system. You become the bank. You lend money directly to companies. They pay you interest and eventually repay principal. Why is this exploding now? Because banks are scared. They're sitting on unrealized losses. They're worried about regulators. They're tightening standards. Good companies that would have gotten bank loans easily in 2020 are getting rejected in 2024. Not because they're bad risks, because banks are being overly cautious. This creates opportunity. Private credit funds step in, lend at higher interest rates than banks would charge, because there's no bank competition. Companies accept the higher rates because they need the capital and have no alternatives. Apollo, Blackstone, Ares, they're all massively expanding private credit. It's the fastest growing segment of alternative investments. Returns? 8 to 12% annually, sometimes higher. Much better than bonds. Similar risk profile if you're lending to decent companies with collateral. You can't start a $10 billion private credit fund, but you can invest in interval funds that do private lending. You can make peer-to-peer loans on platforms that connect lenders to businesses. You can do small-scale private lending to local businesses you understand. The framework: when traditional credit tightens, private credit opportunities expand. Be the lender when banks won't lend. Move 3. They're locking in structural advantages through tax optimization. This isn't about hiding money in the Cayman Islands. This is about legally using the tax code the way it was designed, to incentivize certain behaviors. The ultra-wealthy aren't paying lower tax rates because of loopholes. They're paying lower rates because they structure their income and investments to align with how the tax code rewards capital over labor. Real estate depreciation. You buy a rental property for $1 million, the IRS lets you depreciate it over 27.5 years. That's $36,000 per year in paper losses you can deduct against your income. The property might be appreciating in actual value. You're collecting rent. But on paper, you're showing a loss. That loss reduces your taxable income. Wealthy people use this to offset W-2 income, business income, capital gains. Legally pay dramatically less in taxes. Opportunity zone investing. You sell stock with capital gains. Normally, you'd pay 20% capital gains tax. Instead, you invest those gains into an opportunity zone fund. The gains are deferred. If you hold for 10 years, a portion of the gains becomes tax-free. This isn't evasion. It's using the incentives Congress created to direct capital into distressed areas. 1031 exchanges. You sell a rental property. Normally, you'd pay capital gains tax. Instead, you do a 1031 exchange. Buy a replacement property within the required time frame. The capital gains tax is deferred indefinitely. You can keep rolling into new properties until you die. Your heirs get a stepped-up basis. The tax is never paid. This is how generational wealth is built, not through higher income, through structuring assets to minimize tax drag. You don't need millions to use these strategies. You can buy a small rental property and use depreciation. You can invest in opportunity zone funds. You can do 1031 exchanges. The framework, understand that tax code favors real assets and capital over labor. Structure accordingly. Move 4. They're building private deal flow. The best investments never hit the public market. They're done privately, between people who know each other, through networks you need access to. When a great company needs capital, they don't go public immediately. They raise from private equity, venture capital, family offices. Only later, after the major growth has happened, do they IPO for the public. You invest in the public market, you're buying after most of the gains already happened. You're getting the scraps. Smart money invests pre-IPO, private rounds, direct investments in companies before anyone else knows about them. How? Networks, relationships, access. They're in the rooms where deals happen. They're on the boards. They're the first call when a company raises capital. This isn't about who you know in a sleazy way. It's about being in environments where opportunities flow. Join mastermind groups, attend investor conferences, build relationships with operators, entrepreneurs, other investors, become a valuable connection. So when deals flow, you're included. At smaller scale, angel investing, syndications, private placements, these are accessible to accredited investors, not billionaires only. The framework: public markets are picked over, private markets are where asymmetric opportunities exist. Build access. Move 5. They're creating optionality through portable wealth. The truly wealthy don't assume the US will always be the best place to live, invest, or keep their money. They diversify geographically. Second passports, residency in multiple countries, bank accounts in stable jurisdictions, property in multiple nations. This isn't about tax evasion, it's about options. If the US implements capital controls, they have money outside the system. If taxes spike, they have the option to relocate. If political instability increases, they have citizenship elsewhere. This is insurance against nation-state risk. The same way you diversify investments, they diversify jurisdictions. Portugal's Golden Visa, Caribbean citizenship by investment, Singapore permanent residency. These programs exist specifically to attract wealthy individuals. You invest a certain amount, usually $250,000 to $1 million, and you get residency or citizenship. Now you have optionality. Most people think this is only for the ultra-rich, but $250,000 is accessible to many people with equity in homes or retirement savings. It's a question of priorities. The framework: don't assume your current jurisdiction is permanently stable. Create optionality. Now here's what's important. None of these strategies are about panic. They're about preparation. Smart money isn't reacting to news. They're positioning ahead of obvious trends. Commercial real estate is distressed. They started buying 2 years ago when the trend was clear. Private credit is exploding. They've been building those funds since 2021 when bank lending started tightening. Tax optimization. They've been doing this for decades. They're not smarter than you. They're just operating on longer time frames with better information flow and less emotional decision making. But here's the thing you need to understand. These strategies only work if you implement them before you need them. You can't wait until your bank fails to open backup accounts. You can't wait until commercial real estate recovers to buy at the bottom. You can't wait until capital controls are implemented to create optionality. The move has to be made when it seems boring, unnecessary, maybe even paranoid. That's when smart money moves, when it's unfashionable, when the crowd is complacent. And right now, the crowd is debating cash versus gold versus crypto, asking defensive questions, trying to protect what they have. Smart money stopped having that conversation 2 years ago. They've already positioned defensively. Now they're positioning offensively. They're asking, what opportunities does this crisis create? What assets are mispriced? Where's capital flowing? How do we multiply wealth during the transition? Completely different questions, completely different outcomes. Let me show you the specific mental shift that separates reactive wealth preservation from proactive wealth creation. Most people operate in scarcity mindset during crisis. How do I protect what I have? Smart money operates in abundance mindset. How do I deploy capital to acquire assets from people in scarcity mindset? Same crisis, opposite approaches. This isn't about being predatory. It's about understanding that wealth changes hands during crises. It doesn't disappear. It transfers from people who panic to people who prepare, from people with short time frames to people with long time frames, from people who need liquidity now to people who can wait. If you're forced to sell your house because you lost your job and can't make mortgage payments, you're in scarcity. You'll take a low offer because you need cash now. The person buying your house at a discount isn't evil. They're providing liquidity you desperately need, and they're willing to take the long-term risk you can't afford to take. Wealth transfer. Understanding this changes everything, because it means crisis isn't just threat, it's opportunity, but only if you're positioned correctly. Here's the positioning. The capital ready to deploy. Smart money keeps dry powder, cash or liquid assets ready to invest when opportunities appear. They're not fully invested at all times. They keep reserves specifically for crisis deployment. How much? Family offices typically keep 15 to 30% in cash or cash equivalents, not earning much return, just waiting for opportunities. When crisis hits and assets get cheap, they deploy. They're buyers when everyone else is selling. You can do this at smaller scale. Keep 20% of investable assets in cash or short-term treasuries, earns minimal return but gives you optionality to buy when others panic. Income streams that survive crisis. Smart money doesn't rely on single income sources. They have businesses, rental income, royalties, dividends, interest from private loans, multiple streams. If one fails, others continue. This provides stability during crisis and capital to deploy into opportunities. Build this intentionally. Side business, rental property, dividend-paying stocks, whatever matches your skills and capital. The goal isn't passive income to retire, it's resilience and deployment capital. Long time horizons, smart money invests with 5, 10, 20-year timeframes. They don't care about next quarter, they care about next decade. This allows them to buy distressed assets and hold through the recovery. They can afford to be patient. Most people can't. They need money in 2 years for kids' college or 5 years for down payment, so they can't invest in illiquid opportunities with long payoffs. This is why wealthy get wealthier. They have time frame advantages, but you can create this too. Separate money into buckets. Short-term 0-3 years, medium-term 3-7 years, long-term 7+ years. Only invest long-term bucket in illiquid opportunities. This gives you wealthy style time frame at smaller scale. Tax efficiency obsession. Every decision smart money makes includes tax consideration. Not the only consideration, but always a factor. If I sell this asset, what's the tax hit? Can I defer with 1031 exchange? Can I offset with losses elsewhere? Can I harvest losses to reduce gains? This adds up enormously over decades. The difference between paying 35% on every gain versus 15% or zero is millions over a lifetime. Most people ignore this until tax time. Then they're shocked by the bill. Do it backwards. Consider taxes before every major financial decision. Structure to minimize drag. Network as infrastructure. Smart money invests heavily in relationships, not fake networking. Real relationships with other investors, operators, service providers. Why? Because the best opportunities come through trusted networks. The deal flow happens through relationships. Person you've invested with before has another opportunity. They call you first because you're known, trusted, easy to work with. You're not even hearing about this deal. It's filled before it becomes public. This is why mastermind groups, investor clubs, and high-level conferences are worth the cost. You're buying access to deal flow. Build this intentionally. Attend events, join groups, provide value to others, become someone who gets the first call. Operational excellence. Smart money doesn't just have good strategy. They have excellent execution. Best lawyers, best accountants, best property managers, best fund administrators. They pay for quality infrastructure because poor execution destroys good strategy. Most people cheap out on professional services, use mediocre accountant, don't have lawyer review contracts, try to manage everything themselves. This costs more than it saves. Missed tax strategies, bad deals accepted, opportunities fumbled. Pay for excellence in critical areas. It multiplies results. Now let's talk about what smart money is actually buying right now, not theoretical. Actual current positions being built by family offices, endowments, and sophisticated investors. Energy infrastructure. Oil and gas aren't going away despite clean energy transition. Demand is still growing globally, but investment in new production has collapsed. This creates supply-demand imbalance. Long-term bullish for energy. Smart money is buying mineral rights, royalty interests, midstream infrastructure, not speculating on oil prices, buying the infrastructure that gets paid regardless of price. Water rights, water scarcity is increasing. Agriculture uses massive amounts. Cities need growing supply. Water rights are becoming more valuable. Smart money is buying agricultural land with water rights. Not to farm, for the water. Litigation finance, investing in lawsuits. Law firm has strong case, but client can't afford to pursue it. You fund the case. If it wins, you get percentage of settlement. Not available to retail investors directly, but specialty funds exist. Returns can be 15 to 25% with low correlation to markets. Macabre, but profitable. Returns 8 to 12%, uncorrelated to markets. Royalty investments, music royalties, patent royalties, book royalties, mineral royalties. Any situation where someone created something once and gets paid forever. You buy the royalty stream, get passive income. Seller gets lump sum, both win. Smart money loves these because they're cash flowing, inflation protected, royalties rise with inflation, and uncorrelated. Special purpose vehicles for specific opportunities. See a specific deal? Apartment building for sale at discount. Private company raising capital. Development project needing funding. Create an SPV, special purpose vehicle. Legal entity created for that one deal. Raise capital from network. Do the deal. Distribute returns. Close the entity. This is how smart money does one-off opportunities without commingling with other investments. You can do this at smaller scale. Partner with friends, charge family to buy a rental property through an LLC. Same concept. Notice the pattern? None of these are stocks, bonds, mutual funds. None are things your financial advisor suggests. They're alternative investments, private deals, niche opportunities. This is where smart money actually operates. Public markets are for liquidity and some diversification. Real wealth gets built in alternatives. Now here's why this matters for you. You can't replicate billionaire strategies, but you can adopt the framework. Think in time frames beyond next year. Where will things be in 10 years? Position for that, not next quarter. Keep capital ready to deploy. When everyone panics, be the buyer. Build multiple income streams. Resilience and deployment capital, optimize for taxes. Legal strategies save more than higher returns with high taxes. Invest in network. Access to deal flow is worth more than saving membership fees. Pay for professional excellence. Good advisors multiply results. These aren't secrets, they're frameworks, available to anyone willing to implement them. The barrier isn't capital, it's mindset and effort. Most people want passive investing. Set it and forget it. Index funds, retirement account, check once a year. That works for baseline wealth building, but not for the returns smart money generates. They're actively finding opportunities, actively structuring deals, actively managing tax, actively building relationships. It's work, real work, but it's how wealth multiples during crisis instead of just surviving it. Let me get tactical. Specific things you can actually do at realistic capital levels that mirror smart money strategies. Play 1, private real estate syndications, 25K, 100K. You don't have $50 million to buy an apartment complex, but you can invest $25,000, $100,000 in a syndication that does. Syndication, operator finds deal, raises capital from investors, buys property, manages it, distributes cash flow and profits. You're a limited partner, passive investor. Operator does all the work. Returns, typically 8 to 12% annual preferred return plus share of profits when property sells. Where to find? CrowdStreet, Real Crowd, direct with operators if you have network access. Risk, illiquid, capital locked up 5 to 7 years. Operator risk, bad operator can ruin good deal. Market risk, real estate could decline. Tax benefit, depreciation passes through to you, offsetting some of the income. Smart money does this at massive scale. You can do it at smaller scale with same basic structure. Play 2, revenue-based financing to small businesses, 10K, 50K. Companies need capital. Banks won't lend post-SVB. You step in, not traditional loan. Revenue-based financing. You provide capital, company repays as percentage of monthly revenue until they paid back principal plus agreed return, typically 1.3x to 1.5x. If revenue drops, payments drop. Less risky than fixed loan. Returns, 12 to 20% annualized depending on deal. Where to find? Platforms like Clearbank, Lighter Capital, or direct to local businesses you know. Risk, business could fail completely, lose investment. Slower revenue than projected, takes longer to get repaid. Smart money is doing this through private credit funds. You can do it direct to small businesses. Play 3, buying fractional shares of legal settlements. 5K, 25K, litigation finance at small scale. Platforms let you invest in specific lawsuits or portfolios of cases. Law firm has strong case, client can't afford to pursue, you fund it. Win, you get multiple of investment. Lose, you lose investment. Returns, highly variable, but successful portfolios can return 25 to 40%. Where to find platforms like Legalist, LexShares, though these have minimum investment requirements and accreditation. Risk, cases take years to resolve, very illiquid, could lose entirely, returns are lumpy. Smart Money has entire funds dedicated to this. You can access smaller pieces. Play 4, Opportunity Zone funds, 50K plus. Remember, you can defer and partially eliminate capital gains by investing in Opportunity Zone funds. These funds invest in real estate or businesses in designated distressed areas. You invest your capital gains from stocks, real estate, business sale, whatever. Gains are deferred until 2026 or when you sell the OZ investment. If you hold the OZ investment for 10 years, all gains from the OZ investment are tax-free. Returns varies by fund, typically 8 to 15%. Where to find? Major platforms. Realty Mogul, Fundrise have OZ options, direct with operators. Benefit, significant tax savings if structured correctly. Risk, investments are in distressed areas, higher risk. Long hold period, illiquid, operator execution risk. Smart Money uses this aggressively for tax optimization. You can too if you have capital gains. Play 5, royalty investment platforms, 510K. Want to invest in music royalties, film royalties, patent royalties? Platforms now allow fractional investing. Buy shares of specific songs. Artist gets lump sum, you get portion of streaming revenue forever. Returns, 4 to 8% annually from cash flow, plus potential appreciation if song becomes more popular. Where to find? Royalty Exchange, Songvest for music, various patent platforms for tech royalties. Risk, popularity can decline, revenue drops. Platforms are new, execution risk, illiquid. Smart Money buys entire catalogs. You can buy fractional pieces. Play 6, self-directed IRA for alternative investments. Your 401k and IRA are limited to stocks, Joshua bonds, mutual funds through most providers. Open self-directed IRA. Now you can invest retirement funds in real estate, private companies, precious metals, loans, almost anything. The investments grow tax-deferred or tax-free Roth. Same benefit as regular IRA, but alternative assets. Returns, whatever the underlying investments return. Where? Companies like Equity Trust, IRA Financial, Alto specialize in self-directed IRAs. Benefit, tax advantage growth on alternative investments. Risk, prohibited transactions can disqualify entire IRA. We need to understand rules. Typically higher fees than regular IRA. Smart Money has had access to alternatives in retirement accounts forever. Now you can too. Play 7, creating your own private deals. Don't just invest in others' deals, create your own. See opportunity? Rental property for sale at good price. Local business needs capital. Development land available. Create LLC or other entity. Raise capital from friends, family, network. Do the deal. Distribute returns. You become the operator. You get operator returns, much higher than passive investor returns. Returns, unlimited upside if you execute well. Risk, unlimited responsibility. You're the one making it happen. Relationship risk, investing with friends, family can strain relationships if things go bad. Execution risk, deals can fail. This is how Smart Money actually makes money. They don't just invest, they operate. You can start small. Partner on a rental house. Raise 100K from 5 people to buy a small commercial property. Learn by doing. Notice, none of these are passive index fund investing. All require more effort, more due diligence, more active involvement. That's the point. The returns Smart Money generates come from effort and skill, not just capital. You can't compete with their capital, but you can apply their effort and framework. Here's what actually separates Smart Money from everyone else. Not capital, not connections. Mindset. Mindset. 1. Everything is negotiable. Normal people accept prices as given. Listed price is the price. Smart Money negotiates everything. Property listed at $5 million, offer $4.2 million, all cash close in 2 weeks. Worst case, they say no. This mindset extends to everything. Service fees, interest rates, contract terms, partnership splits. Everything is starting point for negotiation. Why? Because the person with leverage can negotiate, and having capital when others don't gives leverage. You can apply this. Making offer on house, don't offer asking price, making investment, negotiate terms, hiring professional, negotiate fee. Not aggressively, professionally, but always negotiate. Mindset. 2. Asymmetric risk to reward is the only game worth playing. Smart money doesn't make bets where they risk $1 to make $1. They look for asymmetric opportunities. Risk $100K, potential upside $1 million, risk capped, upside unlimited. This is why they love options, early stage investing, distressed assets. The downside is limited. You can only lose what you invest, but upside is multiples. Conversely, they avoid symmetric or negative asymmetry. Don't risk $1 million to make $100K. Apply this filter to every opportunity. What's the absolute worst case? What's realistic best case? Is the ratio attractive? If not, pass. Wait for better opportunity. Mindset. 3. Time is the ultimate leverage. Normal people optimize to save time. Smart money optimizes to use time as weapon. They can wait. They have long time frames. This lets them buy assets others can't hold. Distressed property that won't cash flow for 3 years? Most investors can't wait. Smart money can. So they buy at a discount because most buyers are eliminated. Private company that won't exit for 7 years? Most investors need liquidity sooner. Smart money waits. Gets better deals because competition is lower. You can create this advantage. Separate capital into time buckets. Money you don't need for 10 years can be invested with 10-year time frame. This gives you smart money advantage. Mindset. 4. Bet on people, not just deals. Smart money invests with people they trust, even if the specific deal isn't perfect. Great operator in mediocre market beats mediocre operator in great market. They'd rather back someone proven with track record in a okay deal than perfect deal with unproven operator. Why? Because execution matters more than plan. And they can't control execution. Only operator can. Apply this. When evaluating investments, focus on who's running it. Track record? How do they handle past problems? Are they aligned? Do they have skin in the game? Invest with people you'd trust in different deal. Avoid deals with people you wouldn't trust, even if the deal looks perfect. Mindset. 5. Create value. Don't just extract it. Smart money doesn't just buy low and sell high. They buy, improve, then sell. Buy distressed property, renovate, increase rent, sell at premium. Not just price appreciation. Value creation through improvement. Buy struggling company, improve operations. Grow revenue, sell for multiple. Not financial engineering. Actual improvement. This is why they make outsized returns. They're not just riding markets. They're actively creating value. You can do this. Buy rental property below market, renovate, rent for higher rate. Buy small business, improve operations, sell for more. Requires work, but generates returns passive investing can't match. Mindset. 6. Reputation is currency. Smart money treats reputation as more valuable than single deal profit. They honor commitments even when inconvenient. They communicate transparently when things go wrong. They make investors whole when possible, even if not legally required. Why? Because their network is their deal flow. Burn someone once, you're cut off forever. Your reputation determines who calls you with opportunities. Protect it fiercely. Apply this. Be the investor or partner people want to work with again. Communicate well. Honor commitments. Don't be difficult. Be known as easy, close. This gets you into better deals than trying to squeeze every dollar from each transaction. Mindset. 7. Ignorance is expensive. Smart money invests in knowledge. Courses, conferences, advisors, masterminds. They spend 6 figures annually on education and network. Seems expensive. But one deal that comes through network or one strategy learned from advisor pays for years of education. Most people try to save on education. I'll figure it out myself. Why pay for course when information is free online? Then they make expensive mistakes or miss opportunities because they didn't know they existed. Invest in knowledge. It multiplies returns. Apply this. Stop trying to learn everything free. Pay for quality education. Attend high-level conferences. Join mastermind groups. Hire advisors. The ROI on knowledge vastly exceeds the ROI on most investments. These mindset shifts are more valuable than any specific strategy. Because strategies change. Markets evolve. What works today might not work tomorrow. But mindsets, negotiation, asymmetry, time leverage, people focus, value creation, reputation, knowledge investment, these work forever. Adopt the mindsets. The strategies will follow. And while retail investors panic about cash versus gold versus crypto, smart money is doing something completely different. They're not defending. They're attacking. Buying distressed assets at deep discounts, creating private credit funds, optimizing tax structures, building deal flow networks, creating optionality through geographic diversification, not reactive, proactive, not preserving, multiplying. Same crisis, completely different approach. And here's the thing, you can't match their capital, can't match their connections, can't match their infrastructure, but you can match their framework. Think longer time frames. 10 years, not 10 months. Keep dry powder. cash ready to deploy when others panic. Build income streams, resilience and deployment capital. Obsess over tax efficiency, legal strategies that save more than they cost. Invest in network, access to deals, beats, saving on fees. Pay for excellence. Good advisors multiply results. Negotiate everything. Leverage creates opportunity. Seek asymmetry, limited downside, unlimited upside. Bet on people. Execution beats strategy. Create value. Don't just extract, protect reputation. Future deals depend on it. Invest in knowledge. ROI exceeds most investments. These aren't secrets, they're frameworks, available to anyone. The barrier is mindset and effort. Most people want passive, easy, set and forget. That works for average returns, but not for the wealth multiplication that happens during crises. Smart money is actively positioning, actively seeking opportunities, actively structuring deals. It's work, but it's how you move from defending wealth to creating it. The next few years will see massive wealth transfer, from people who panic to people who prepare, from short time frames to long time frames, from scarcity mindset to abundance mindset. Which side are you on? The crowd is debating cash, gold, crypto, defensive questions, reactive positioning. Smart money stopped having that conversation years ago. They positioned defensively already. Now they're positioning offensively. They're asking, what does this crisis create? What's mispriced? Where is capital flowing? How do we multiply during transition? Different questions, different outcomes. You can keep debating the three obvious options, or you can recognize there's a fourth game being played that most people don't even see. The game where crisis creates opportunity, where wealth transfers from panicked sellers to prepared buyers, where long time frames and patient capital generate outsized returns. That game is happening whether you play or not. The question is, are you going to keep playing defense with the crowd, or are you going to start playing offense with smart money?